Markets rebound, and just like that, bullish conviction is back as the Nasdaq 100 hits another record high as Taiwan Semi reported earnings as what looks like a litmus test for tech earnings over the next 2 weeks. But as we get into the thick of it and global uncertainty looms, let's talk about what we can expect tomorrow and for the month ahead. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the notification bell. Let's get into it. Today's rally was entirely led by technology, specifically semiconductors after Taiwan Semi's earnings double beat. We're going to talk about that later. Apple saw a huge rebound on some upgrade news. We're also going to talk about that, but Tesla did not participate, as well as real estate, energy, utilities, and some of the bigger names in healthcare. But all in all, it was just risk on, buy whatever you could. Financials held in there too. Industrials were one of the best performing sectors as a whole, but it really was technology, the star of this show. And we got the latest sentiment survey today. We've seen bullish sentiment pull back. I mean, look at the historical average. We're sort of there a little bit higher than normal, as well as bearish sentiment tick up. But one thing that was interesting is a neutral right here is sort of at its historical average, which is very, very good. And we're well off the 1 year bullish high. And what I can almost say with certainty is that our turn of the year barometer, the best reliable indicator, the one I've been showing you all week, is probably going to have a bullish trigger tomorrow unless we totally dump 2.87%. Highly unlikely. Possible, but highly unlikely. And you could see here that we're probably going to go 36 wins, 2 losses right here. Average return 12 months later, 16.48%. And here are the majors today, guys. We saw technology perform the best, and that's why the Nasdaq was up 1.5%. But everything sort of participated. SP500, that's nothing to scoff at. IWM and the market as a whole performed. What didn't perform well was bonds, and bonds are doing their own thing because the yield curve is starting to normalize. We're going to talk about that a little later. Now, looking at election year seasonality, this is where we are right now. And normally the first half is actually quite choppy. 66% of the time higher, not much to go off. And we are actually kind of flat on the year. We're only up 0.25% in the S&P 500. And to be honest, expect more of this price action throughout the first half of 2024. But looking at the second half, 83% of the time it's higher, 7.62% on average. Median returns a tad above 6%. So just something to note there that, choppy action through the first half of the fourth year of the presidential cycle is actually very, very normal. Now let's talk earnings. TSM reported earnings, a double beat. They beat on EPS, reported 1.44. The forecast was 1.38 on revenues of 19.62 billion. And if you had a look at what TSM did on Thursday's trade, someone definitely knew something because it was up like 4% from the lows, and pre-market TSM opened plus 4% and it was up a full 9% today, somewhere around there. And this took semiconductors and technology with it. Now let's actually have a look at earnings expectations. We got the latest figures right here. Healthcare still on top, in a close second technology, and technology and healthcare are kind of flipped on the sales and net margin. 9.4% sales for tech, 5.3% on the margin front, 14.7% earnings per share, and then healthcare 5.2% sales per share with a net margin of 9.7, brings the total earnings per share to 14.8%. What's really interesting about all of this is that every single sector, including energy, is expected to produce earnings growth for a total earnings growth in the S&P 500 of 10.1%. Now at the start of January, this was 10.8%. We are seeing revisions to the downside, but this is normally what happens, and we are still expecting double-digit growth, and especially because I'm very concentrated in comm services, technology as a whole, this is what I really want to look at, and we still are in the double-digit regions for these sectors. And here's some more interesting data on earnings. Prometheus Research says earnings expectations begin to look cheap versus the current macro trends, and this is earnings expectations and GDP growth, and GDP growth is outpacing earnings expectations, and they normally track each other very, very well. And so maybe, and if we do meet in the middle here, maybe we see better earnings in the second half of 2024. Just something very, very interesting I thought I'd show you guys there. Now we got the latest GDP Now data. It actually has ticked up to 2.4% in GDP growth for Q4 2023. Kind of crazy when you think about it. This is the consensus estimate, but I think the Atlanta Fed has some of the best data that they can, and they can predict this very, very well. So GDP moving higher, all things considered. In sight of this, active fund managers have actually decreased their exposure. This is the NAM number. It's just essentially how exposed active fund managers are to US equities. Last week, they were at about the 80% range. We're now at 53.54. And I think a lot of active fund managers are taking bread off the table, looking at OPEX week and how negative it normally is. Now, let's talk more data we got today from BOFA. They say household net worth at 146 trillion, 540% of GDP, 2/3 of it coming from traditionalists and boomers, as you can see right here, and most of it probably being in stock as well as real estate. And they say that a lower Fed funds equals less compelling income from cash. So as the Fed cuts, we probably will see some of the transition of cash into maybe stock markets, bond markets, other real estate ventures. All in all, this is what we're sitting on right now. And I wonder when, boomers will transfer this wealth to Gen X, millennials, traditionalists, etc. Now, supporting higher net worth is jobs data. Jobs data came in at a double beat as well. Initial jobless claims 187, consensus was 207, continuing claims. And I thought because of the seasonal adjustments, this was going to be like 1900 plus. It was not. It was at 1806, consensus 1845, and the job market continues to be tight, and wage inflation is proving to be a lot stickier than many people thought. However, the effects of a tight labor market on wage growth should diminish as inflation falls. Inflation is falling, and therefore wage inflation should fall as a result. And much of the increase we've seen in wage growth was driven by inflation itself, as well as pandemic distortions that are now abating. So the strong wage inflation we've been seeing, anywhere from the 9.3 to the 3.8% range, is sort of starting to normalize, and the Fed wants this in the 2 to 3% range. So do expect the Fed to try and get this to that level in 2024. Another piece of data we got today was housing data, building permits and housing starts. And housing starts did fall, building permits, however, did increase. And this is why home builders were so bullish today. Building permits, which is just like a future number of what housing starts will do. And it just shows that there's more activity starting to brew in the housing market. And here's what the jobless claims data and the housing data did to the yield curve. Nothing much changed. We're still expecting about a 50 to 60% chance of a rate cut either in March or May. 59.5% in March, 49.4% in May. And all things considered, what we are looking at is definite rate cuts. The Fed's tone has changed into 2025, and I do think into 2024, and I do think we definitely need these rate cuts, because with CPI right now at a 3-month annualized rate of 1.9% and Fed funds at 500 basis points, the real cost of capital is simply too high, and that's going to cause the recession. So the Fed needs to cut sooner rather than later. Now, what we are starting to see is the yield curve start to normalize. We're seeing specifically the 2-year and the 10-year really starting to normalize. The spread between this was significantly wider. It's now closing. Now, the Fed does control the shorter end of the curve, and when they do cut rates, we're going to see further normalization of the yield curve. And I do think the Fed has a desire to normalize the yield curve, probably to help out banks. An inverted yield curve is not really good for banks and their lending programs. And the banks did some stress tests in Q4 2023. And what they found is that 10% of commercial real estate from 33 banks was exposed to CRE commercial real estate losses, 15.6% in credit card losses. And I do think that if the yield curve was to normalize, these figures should improve dramatically. And here is the current spread between the 10-year and the 2-year. This zero line means the yield curve is uninverted, or the 10 to 2-year spread is uninverted, and we're slowly getting there. You can see we are moving up. There have been bumps along the way, but all in all, trend is higher towards uninversion and normalization. Now, here is some data on asset performance and rate cuts. Now, rate cuts are normally very bullish. The Fed cuts rates 12 months later, 9%, 23%, 13%, 10%, 27% rally, all things considered. In recent history, rate cuts has been very good for gold as a whole. Looking at the graph and plotting this out, equities tend to do really, really well after the first rate cut, as long as there's no recession. During non-recessionary periods right here, now this is indexed to 100, and that's a 50% return 2 years later. But if we do get a recession, it does look very, very rough, all things considered. considered. Now, equities rally where there normally is a desire to normalize the yield curve. And I think that's what the Fed wants to do. One of the reasons why they want to cut is because inflation has come down, want to normalize the yield curve. The shorter end doesn't really move unless the Fed funds moves. And this is what we normally see. Unless we get a recession, equities normally rally 40, 50% within a 2-year period. And the dollar, normally not much happens. I mean, it normally increases about 2 to 3% after Fed cuts, according to the full sample right there. One thing I found weird about this data is that non-recessionary periods in the dollar beat recessionary periods. And you would think that like in periods of recession, you'd want to hold USD over, well, any other currency. So just some weird data right there. And no surprise, after Fed cuts rates, yields tend to fall. And it's quite significant. In recessions, right, we normally see a 3% cut in yields, whereas in non-recessionary periods, it's normally about 1 to 0.5%, but the sample of full results, 1 and 2%, call it 1.5%. Now, looking at the best sectors around a Fed cutting cycle, it tends to be staples and healthcare, although this is just the data as a whole. We see the worst sectors tend to be info technology, tech, as well as financials, but I would have loved to see this data split between recession versus non-recession, and the hit rates on like tech and financials are not that great, 25% hit rate here, under 40% hit rate here. It's very, very all over the place and not data that you should go off. Now, let's switch gears and actually talk about sectors today. The best performing sectors: semiconductors, technology, cyclicals as a whole, home builders as well, communication services, really these risk on sectors. Regional banks put up a very good day too. And the best performing sectors so far for the years, I'm talking financials, healthcare, didn't do so well today, all things considered. Now, we are currently in max pain, and I have been telling you guys that the 470 to 475 region is where we're going to trade for the week. That's exactly what we're doing. We went all the way down to 470 yesterday. We're back up to the 476. Max pain is at 475. And I do think we're probably going to have a flat day tomorrow and maybe trade at or around the 475 area. Now, looking at January seasonals, currently we are up 0.25% for the year, but it has been a very mixed January, down and up, and we are entering the window of weakness. This dealer supporter flows called Vanna and Cham are essentially on holiday. They're not normally going to be there, and they do come back around the 31st of January. Now, today's trade was entirely a gamma squeeze. As this right here rolls off, we saw a ton of negative gamma come into the tape yesterday after being quite positive gamma, and that led to a gamma squeeze. And here is the gamma looking at tomorrow, and we could see that right here on the 19th there's a lot of negative gamma that's going to expire. Now, I don't think we're going to get a squeeze like we did yesterday. It's probably just going to be very flat trade as dealers unwind their positions, because I do think that a lot of the rally had to also do with TSM's earnings and looking at semiconductors and future earnings and saying, hey, this could be very, very good. Now, all things considered, we do get a lot of vol supply after the 31st of January when we get back into the strong Vanna and Charm flows, at least what's in there for the tape right now. So all in all, we are in a very weak period. That's not to say we absolutely dump. We could have a correction in time, and as earnings come in, technically the S&P 500 would then be like undervalued by 5 to 7%, especially if tech earnings and healthcare earnings come in very, very good. All in all, we get a lot of these positive gamma flows again towards the end of January. Now, looking at the gamma heat map, and this is definitely something I wanted to show you guys. This neutral gamma zone right here and here has expanded over the last couple of days. We're also seeing a lot of negative gamma sort of come into the tape right here. And if we compare it to the last 3 days, this is what I mean. So this is the 16th, this is the 17th, this is the 18th, and have a look at this neutral gamma zone. It was very, very thin, and there was quite a lot of positive gamma pockets right here, here, as well as here. The next day, this expanded significantly. There's a huge gamma pocket right there, as well as there. Today, the neutral gamma zone didn't expand as much, but we're seeing more negative gamma come into the tape, and these positive gamma zones right here and here, still there, but definitely weaker. But let's have a look at the charts. The S&P 500, I mean, you would look at this and you would say high or low. If it goes and breaks these highs on a technical basis, you have to look at this and say, hey, that's actually quite bullish. I mean, now looking at the intraday chart, and I think a lot of people got short right here, then we gapped up, they were really worried. And then when we got to this point right here, a lot of people just closed off their shorts for even, and then we just rallied. Looking at TLT, I mean, we went above, came below the 200 moving average. There's no real level of support to look at, maybe besides like the 82 region. All in all, not looking too good for TLT. But looking at dark pools, we've seen huge amounts of trades come in right here. And I mean, these are probably shorts looking at taking it down, but we're seeing the second largest trade since inception come in right here. So there could be buyers stepping in at this level right here. And this has been a high volume node. So I think there's a lot of big players defending their position right here in the 20-year. And looking at the AGG, very similar situation to TLT, although looking a lot stronger. If you're wanting to buy, look at this 200 moving average. Maybe we find support right here. That could be very, very good. I am actually still bullish on bonds throughout 2024. And we do know that when the Fed does cut rates, yields tend to fall. And that's really good for bond prices. Now, looking at the 10-year, and this is what's worrying me. I mean, this was a very strong support zone. And there was double confluence with the 200 moving average. We've broken above. And what does this mean? I mean, probably 4.3 for the 10-year is what you want to look at right now. That's the next level of support. And maybe if we retrace back here, we want to see how the 10-year reacts at the 4% range. Looking at the SP 400 mid caps, and what mid caps need to do is go ahead and retake this level right here. We want to see how it reacts at this line. If it rejects, probably means lower price action to here, but if it gets above, that's going to be very constructive for mid caps. Very similar situation for small caps. This is the weekly chart. It did reject this line right here. A lot of people got tricked into going long, but we did bounce off the 200 moving average. The Russell 2000 needs to go ahead, move up into year and break above this line. If not, if it rejects, we probably have to look at lower levels of confluence again, like this 200 moving average, or maybe even some of these lower levels right here at 170. But all in all, mid caps, small caps are not looking too strong. Now, I want to bring some data to your mind with regards to small caps and the bull case. Yesterday, I went over Europe large caps and their expected returns for the year. They are expecting growth of about 10% for Europe, but small cap growth is expected to be higher. The FTSE small cap is expecting 49% growth over the next 2 years. The MDAX, which is the mid cap in Germany, is expecting 19%. And you could also see all of this right here. In the last 2 years, the number one contributor to falling stock prices has actually been forward 12-month PE contraction, especially in small caps. 35% PE contraction has led to where they are right now. And currently, small caps are 16% below January 2022 level. So all in all, even though small caps have had quite the rally, on a PE basis and a growth basis, they are still quite undervalued. But on a technical basis, small caps are not looking too good on the charts. Now, moving along to the equal weight, and we did bounce right here on the equal weight. What the equal weight really needs to do is go ahead and retake this 155 region. If it doesn't, and it does reject, I mean, we probably have to look at the 149, maybe the 150 area for small caps. Now, this is the XLF. Financials very, very strong. I mean, it's staying above this key level right here, and it bounced off it. This looks very, very strong. And even so, if it does go below, this moving average is right there to support it as well. So financials looking very, very good at the current moment. And if it does just consolidate here, it probably means we go higher, especially as some more of these regional banks report earnings tomorrow and for the week ahead. Looking at Apple, it did exactly what I said it would do. It's bouncing off its 200 moving day. It had a massive upgrade and rallied like 3% today. Absolutely insane. And I do have a price target on it of 192. I personally did not buy, however, but let's actually look at the upgrade, and it has to do with this right here, the Apple Vision Pro. Now, Bofa said, and you guys can go ahead and read this, that the AI Vision Pro are the drivers for upside to the hardware and services for Apple, as well as raising iPhone and services estimates. They do believe that an iPhone upgrade cycle is due, and they're looking past near-term order changes in the supply chain and looking towards what Apple can do throughout 2024, 2025. Now, there are risks to the market. They do say risk include GM pressure from higher bills of materials, costs, order cuts from weaker demand, as well as China iPhone pressures. And we do know what's happening in China, as well as delayed AI uptake and a weaker consumer spending in 2024. But all in all, they raised their price target to 225 from 208 on a 32 PE on consensus earnings per share of $70. Prior, it was 6.45%. So Bofa is really betting big on the Vision Pro, as well as that iPhone iPhone upgrade cycle and services estimates. Now, looking at Nvidia, it's losing a bit of steam up here, but all in all, you don't want to bet against this. But any pullbacks, you do just want to buy for further upside towards the 600, 650 area. Looking at AMD, and it has had quite the rally, especially in the last 3 days, but we have seen a very, very ugly candle right here. We want to look at levels of support, particularly around the 150 area if it does pull back, especially over the next couple of weeks. Taiwan Semi up 9.79% today, absolutely gapped up, and I do think it's probably going to go even higher, especially as a lot of the headwinds to their earnings over the next year or 2 years are sort of behind them, and TSM is poised for further growth looking ahead. Now, here's some very interesting stuff. Someone knew something, because we saw big trades happening in here, and then we saw liftoff, and then further big trades coming in at the tape. Now, this could be a short, but based on the earnings that released and how strong this is, I wouldn't bet that it's a short. Now, looking at Spirit Airlines, ticker SAVE, absolutely wild. Now, it doesn't look like it, but you see this move right here? That's 35% from the lows. 35% move from $4 to $5.70. Absolutely insane movement in the stock right now. And it's purely because they're having real trouble getting liquidity, getting capital, getting credit to support their business, because a judge blocked a merger acquisition between SAVE and some other airline. Very, very interesting. So at the end of the day, the number one thing is the fundamental and the macro. It governs everything, even beyond option flows, technical analysis, fundamental analysis. If a judge says no, things are not going to go your way. Now, looking at Tesla, guys, and Tesla is at a very key point right here. I mean, if it breaks below, we're probably going to go to like this trend line right here. And this is where we are right now with Tesla. A lot of people were expecting like a breakout here. It's a failed breakout. And I mean, here it's a failed breakout and not looking good for Tesla shareholders. And this is what I've been saying. I said I wasn't buying the breakout. I just wasn't seeing anything in Tesla to support this breakout thesis, especially as certain things, I mean, their Berlin plant near the Red Sea, they closed that because of safety concerns, and the demand for the Cybertruck isn't quite there. Not looking good for Tesla, but trust Elon Musk to really turn anything around. I wouldn't bet against that man. And here's some dark pools for Tesla. I mean, again, probably someone knew something, because we saw some big trades at the high, so we probably go lower for Tesla. Now, data for the week ahead, guys. Tomorrow we get existing home sales and then Michigan consumer sentiment. But if you've made it up until here, guys, thank you so much. If you like this video, please subscribe, hit that notification bell, guys. Like this video, leave a comment. Cheers.